Welcome to my channel. I'm the cover call guy and I'm trying to create a $120,000 per year passive income portfolio using only cover call ETFs. Right now my portfolio yields about $72,000 a year, about $6,000 a month, $1,400 a week, and about $200 per day. Legal disclaimer before we start this video: this content is for informational and educational purposes only and it should not be considered financial, investment, or tax advice. I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be incorrect or incomplete. Investing and trading involves significant risk, including possible loss of principal, so please always conduct your own due diligence and consult a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot on YouTube and I could be completely wrong. And with that out the way, today's video is going to be on assets under management, right? This video is just going to be on the cover call ETF power rankings by assets under management, right? Because for those who are new, welcome to my channel. Thank you for subscribing. Thank you for liking, commenting, and sharing your thoughts, whether it's good or bad, disagree, agree. I don't delete any comments, and I appreciate all opinions. I try to respond to everybody, and if you have a request, I will try to go ahead and make that happen. But if you are not a new subscriber, I always talk about assets under management because it does play an effect, right? It does matter, right? So this video is going to be the truth about cover call ETF assets under management, the assets under management, oh God, the assets under management truth. Size matters. Size does matters. Don't let anybody fool you, okay? Size matters, okay? If they're saying size doesn't matter, they're lying to you. Alright? If you're inexperienced, size matters. Alright? And I'm talking about investing, okay? Investing wise. But in all aspect of other life and other areas in life, size still matters, okay? So don't let anybody fool you, alright? She's lying to you. Size matters. So since for those who are new, um, I talk about assets under management a lot in my other videos and of all of the deep dives. And I didn't really get into a deep dive, but this is going to be a deep dive into why uh, um assets under management matters. Right? The truth, right? Assets under management truth, size matters, right? Assets under management serves as an ultimate um arbitrator of strategy viability in the derivative income space. What that just means, it dictates liquidity costs, right? The bid ask spreads. The higher the bid ask, the less profits your ETF, the fund manager, makes, right? So that matters. It determines the execution efficiency, right? Volatility capture versus suppression. It dictates the survivability, right? Profitability versus liquidation, right? Crucially, this report is going to highlight the microcap death zone, which is the 20 million to 50 million, where wider spreads and fixed costs erode investor total return. So my lowest is going to be around 20 million to as high to the biggest one. I stopped putting in comparisons and other stocks and ETFs that are below 20 million. I just feel like they have to prove themselves. They are way too new, and you shouldn't really be looking into anything that small anyways, because it comes with those inherent risk. And this channel is all about survivability, the long term, right? When I try to buy something, I want to look at it for the 30, 40, 50-year hold. All right, the data methodology behind my report, right? The assets under management verification, right? So the figures are sourced from triangulation of issuers' website that I use: JP Morgan, Global X, NEOS, right? And pretty much all of the funds that I went to, and I've gathered all the data that was available. They put out whatever they can, else you have to pay for it. I didn't pay for it. I just use primary market data aggregators, Morningstar, ETFDB, Y charts, and regulatory findings as early of December 2025. And then I just did an estimate of the revenue and spreads, right? Revenue estimation calculated by multiplying verified assets under management by the fund's gross expense ratio. serves as a proxy for survivability and spread quality, liquidity assets based on average daily volume and bid-ask spreads consistency. So a lot of these are as close as I could get with my estimations, my calculations. So give or take, plus or minus a few, maybe half a point to a point to a point and a half off. Forgive me on that. Again, I didn't pay for the most up to date. I just used whatever documents and estimates that these funds release themselves. And of course, you can always do your own due diligence if you want to go ahead and pay for it and make the more accurate calculations. But for the most part, this is quite accurate already. It's not like I'm off by like 10, 20 billion, right? All right, the structural definitions, right? ELNs, right? Equity linked notes, structured debt notes issued by banks, distribution tax as ordinary incomes. That's what ELNs are. 1256 options, index options traded on exchange, gains qualified for 60% long term, 40% short term tax treatment. Synthetics, that just means buying calls plus selling puts, capital efficient. However, introduced counterparty and strategy risk, often backed by treasuries. Often, but 99.9% has to be backed by treasuries. And then daily or 0 daytime expiration options. These options expiring same day or next day. High turnover, potential for gamma risk, but daily premium capture. All right, the ecosystem hierarchy, the top tiers, right? The tier ones, the titans. We consider them over 10 billion in assets under management, and the two titans would be JEPI and JEPQ form JP Morgan, right? The characteristic behind this, the deepest liquidity, volatility dampening effect on the market, ultra tight spreads. So they get the best value when they ask for these options or flex options or whatever they want, the equity linked notes. They get the best cost because, right, when you buy, think of it as if you own a business and you want to buy something, typically you're gonna get the best price on wholesale, right? And even more if you want to buy even bigger branch of things. I'm trying to find an example here, but for the most part, if you go on, if you have a business or you run a business or if you are ever a manager in logistics, typically when you buy wholesale or extremely large wholesale, right, you're trying to fill up Amazon size warehouses, you're gonna get the absolute best price. So that's what JP and JP Morgan yes, they get the best price in terms of the options market. And then we have tier 2, the institutional scale, right? 1 billion to 10 billion. These would be the NEOs, right? And the Goldman and Amplified DIVO, right? QQI, SPYI, DIVO, GPIX. They pretty much get the same type of deals, if not very close. The characteristic is that it has strong survivability, efficient execution, preferred by RIAs for tax and cost benefits. And RIA just means registered investment advisor, which is just an individual or firm, and in this case, a firm that provides investment advice for a fee. It can refer to a specific international money transfer service offered by some post office, but in this case, it is a firm, typically a hedge fund, right? A fund manager. All right, the ecosystem hierarchy, the lower tiers, right, the tier 3s, these are the retail / tactical. I would group these in the 100 million to 1 billion. For example, is NVDY, TSLY, QDTE, right? The characteristic here is high yield, higher chance of NAV erosion risk. Flows are highly sensitive to market volatility. Then we have tier 4, which I consider the danger zone, right? Is less than 50 million in assets under management. For example, some are TDAQ or YLG and any micro cap yield max funds, right? The characteristic behind this is that it has extremely widespread, which means they're ask bid options, pretty much the option buys, right? They have the worst market availability, right? So it's pretty much goddamn near retail, right? When you purchase an order on Robinhood, Fidelity, or whatever you use, typically a small retailer like us would end up with a higher price, where you go up against someone like Berkshire Hathaway, right? They're gonna get the price and the amount they want, or even better, they're gonna get the best of the best deals. Right, so risks of delisting, liquidation, issuer subsidy often required to stay afloat. All right, and this is my master ranking, right? The Titans 1 to 11, right? We have number 1 at JEPI from JP Morgan. Assets under management, my estimate is about 41.33 billion. The structure they use is ELNs. Spread is ultra tight, which means they get like 1 or 2 cents. That's it. 1 or 2 cents of like above or below asking price, right? The tier is Titan, JEPQ, JP Morgan. Again, from JP Morgan, assets under management is 32.15 billion. The structure is ELN. Spread is ultra tight. Tier, Titan. And then QYLD is Global X. Assets under management is about 8 billion. Structure is passive. Their spread is ultra tight. I consider that a Titan too. Then we have QQI and SPYI, right? They have about 6.77 to 6.45 billion. Their structure is 1256, very tax efficient strategy. Their spread is also ultra tight, and their tier is institutional. And then we have DIVO at number 6, KNG at number 7, 8 at XYLG at 8, GPIQ at 9, and these are all the spread I would consider is very, very tight, and institutional tier. Then we have 12 at FTHI at 12, First Trust Buy Right, assets under management 1.77. These are again institutional tier list. The spread is tight. TLTW at rank 13 with 1.66 billion. NVDY at 14 from YieldMax at 1.61 billion. And then we start. They're still institutional, but the spread here will now start going away from tight to moderate, right? So RYLD at 15th place from Global X 1.25 billion. TSLY from YieldMax at 16th place. SPYI at 17th place. And then QDTE from Roundhill at 18th place. Right now we get under 1 billion. Right, QDTE at 961 million assets under management. The spread is moderate. Tier is growth. They are on the growth path to becoming an institutional stronghold. Right, and then we have Coney from YieldMax at 19th place with 885 million assets under management. The spread here is now starting to get wide because of their strategy also, but they are still growth. They are becoming a powerhouse. All right, and then we start having all the tiers now growth. The spread is now moderate to becoming wide. Right, at 23rd place is Bally. And at 24th place is BLTY. At 25th place is FIPI. At 26th place is IDVO from Amplified. At 27th place is YMAG. At 28th place is AIPI. At 29th place is XDTE. At 30th place is WTPI. At 31st place, IQQQ. As you can see right now, it's just the assets under management is starting to get much lower, right? Bally at 647. Then we have IDVO at 565. And then we have 31st place IQQ at 318 million, right? And the tier right now is still I can still consider growth. But however, the spread is starting to be moderate and tight. So we start have to, we don't really have to worry much, but we start to have to keep an eye on it. All right, master ranking retail and danger zone. This is 34 to 44. At 34, LQDW from iShares. Now the assets management is under 300 million. I still consider a growth tier, right? And then 35th place is Pappy. 36th place is from Google, GOOY. 37th place is GQI. 38th place is QQY. 39th place is RDTE. 40th place T-SPY. And then at 41st place, we have our first retail, right? Now APLY from YieldMax at 41st place. I consider that tier a retail, right? Now is 145 million assets under management, right? We are just above the 100 million zone. And for those who are new, I consider a cover call ETF has graduated from the baby stage once they have crossed that $100 million zone. These have, but we still have to consider that they don't get the best spread. We have to consider their structure, and we have to consider their tier. And I must say, at 41st place, now it's a retail tier. And then we have 42nd place, IWMY from Defiance at 130 million, retail tier. Right, so the Titans, let's talk about JEPI and JEPQ, right? JEPI at 41.3 billion, the category king, right? It is the absolute beast, right? So JEPI's massive assets under management creates its own weather system. It uses equity-linked notes, ELNs, to sell options. Why does matters? Size pins volatility, potentially reducing premiums. Liquidity guarantees razor-thin bid-ask spreads, right? Literally a cent. Cheapest to exit and enter. JEPQ at 32.2 billion, right? Introduce capacity risk, must trade liquid index options, cannot target smaller tech stocks. So tech stocks on nimble funds that cannot target smaller tech stocks, nimble funds can. It got cut off. All right, tax efficient challengers, the QQI, SPYI from NEOS. The tax advantage, NEOS solved the tax problem using Section 1256 contracts, the 60/40 tax treatment versus JEPI ordinary income ELNs. So if you don't want that certain Titan, you can go to this certain Titan, right? So the institutional validation here is crossing the 5 billion threshold was critical, right? That is what I consider like the next holy grail. Right now it's onwards to the double digit, right? Sticky capital validated for use by large RIAs who have minimum assets under management requirements. Why matters? Stabilizes the fund during market downturns, unlike hot money retail flows. Right, the cost leader, right? GPIX and GPIQ from Goldman Sachs, right? They have the pricing power here. Goldman entered late, but with a bazooka at 0.29 expense ratio. They are declaring a fee war, right? Undercutting the industry standard of 0.60 plus. Rapid ascent, about 2.3 billion in just over a year, proves institutional sensitivity to fees. The scale, this levels allow them to trade efficiently while squeezing competitors. So hopefully they continue to wait for another year, possibly. We don't know. If they keep this up, they will be on their way to becoming a 5 plus, 7 plus, possibly even a 10 plus billion within the next 3 to 4 years. The single stock unicorn, Misty, MSTY, right? Misty at 1.93 billion is an anomaly, right? A single stock ETF with mid-cap index assets under management. It tracks MicroStrategy, MSTR, a Bitcoin proxy. However, it has a concentration risk, right? Misty holds a massive position in MSTR derivatives, which can lead to liquidation events. Unwinding options could directly crash underlying stock prices. Why does it matter here though? This risk is the trade-off for triple digits yield. The NAV erosion risk from TSLY and NVDY, right? The yield trap here. TSLY at 1.18 billion, high assets under management. However, it's suffering NAV erosion due to Tesla's volatility, right? It is a melting ice cube. Just think of it that way, okay? It is a melting ice cube. You get the full cube now, but a couple of weeks or months later, it is going down, okay? To maintain dollar payout, the funds must take aggressive risks as share price drop. And then you have trapped capital, right? Large represents investors hoping for a recovery that is mathematically difficult. NVDY's 1.61 billion, a whale in NVIDIA's options, potentially compressing yields over time. That is how they could possibly survive. All right, the microcap danger zone, right? TDAQ, TDAQ at 47 million. It's a viability zone, generates enough to survive, but trading spreads are 10 to 20 cents wide versus 1 cent for giants, right? So you guys see the difference, right? And I say it matters because for us, we say, oh my God, it's just 1 cent, right? 1 cent, oh my God, it's just 5 cents. Oh my God, it's 10 cents. Who cares? But we are trading from a couple of shares to a few hundred shares. And at most, if you guys have the money, you guys might be buying 500, 800, 1,000 shares at a time. That is nothing to these fund managers. They are trading from a few 100,000 to a few 100 million at a time. So that 10 to 20 cent difference, that is a lot. That is eating away at your profits that they're giving out to you. Remember, you guys have to pay the expense ratio too. Okay, they have to make a profit. So you guys have so now I hope you guys are understanding why this matters, why assets under management matters, because a lot of people just think, oh well, I can just, these smaller funds are doing better, blah 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 blah. Yes, for now, the market is in their favor. When it's not, and they don't have the money to back them up, back themselves up, they can get liquidated easily, gone. All right, then we have RYLG at just about 8 million. I say this is a zombie fund, right? Costs more to run than it earns. High risk of closure, liquidation. It's forcing investors to realize capital gains losses at inappropriate times. Okay? And I didn't mention TDAC here, the last sentence at investors pay a liquidity tax to enter. Survivability analysis, break even math. So this is my type of conclusion, my estimate. For those who are new, I like doing this for every slides. I'm not sure if you guys like it, but I kind of made it a thing now in every video. I kind of give my take, my insight. These are my guesstimates, right? This is my model. This is nothing factual. I just try to put some formulas together and then I run the numbers and I say, okay, this is how I think it's going to go. If it goes, the market will go this way. This is how I think it goes if the market goes the other way. So for JEPI at 0.35% expense ratio with a 41.3 billion assets under management, they earned an estimated annual revenue about $144.5 million. That is why they're a status of a titan. QYLD at 0.60, assets under management is about 8 billion. They earned about an estimated annual revenue about 48.1 million, and is why they're still considered a titan. TDAQ, TDAC at 0.68% expense ratio with a $47 million assets under management only earns $320,000. And right now, if they don't keep that up, right, their status right now is sustainable. So they're just making enough to sustain themselves, to keep the fund going, and to pay everybody, to have the fund managers and all their team paid out, right? So you guys have to be careful if you own this. Right? Keep a close eye on it. If they're not growing, then we have critical issues here. And then we have RYLG at 0.60 expense ratio with an assets under management of 8 million. They make just about 50 grand estimated annual revenue. Status is critical. They're about to blow up, right? I mean, I'm sure most of you guys make more than 50 grand a year. You guys might as well run your own fund at this point. Really. All right, strategic insight. Funds like RLG are on a watch list for liquidation, in my opinion. TDAC has crossed the safety threshold, but needs to reach 100 million to ensure tight spreads. Okay, so we have to keep an eye on them. If they can't cross the 100 million mark within a year or a little over a year, we have to consider them to be gone. Let them go. Okay, that means something fundamentally is wrong. They can't keep up. My verdict here is that assets under management doesn't lie, right? It tells us the market values safety like JEPI and tax efficiency like NEOs. While micro caps offer innovation, they carry hidden costs, right? In 2025, this is no longer a product arms race. It has become a liquidity arms race, right? A lot of people give me heat because I talk about TDAC and, T alpha and all this other stuff. There's a reasoning behind my thoughts, right? I'm not trying to push down anyone. I want all of my subscribers to make money, right? Like I say, I'm very serious about it. I want all of us to meet up one day on a nice beach in our own yachts, right? We're gonna have a nice, huge yacht party, right? But you guys have to consider the things I say is because there's reasoning behind my little brain. I mean, consider I'm sure a lot of you guys are much smarter than I am, but I analyze it and it just comes to a point where if they're not crossing a certain threshold by a certain time, that means they are structurally very, very fragile. And I don't want you guys to be risking money if you don't have to, right? There are greater funds that does the exact same thing. Yes, they might not always beat the market or other funds every single time, but you can sleep well at night, right? Swan, sleep well at night is another thing I say a lot. So hopefully you found this video educational and informative, right? Please join the conversation, right? Do you own Titans or are you playing in a danger zone, right? Thanks for watching. Subscribe, like, comment. Catch you guys on the next. Stay tuned.